You know that feeling. The one where you step on a cruise deck and all your worries just melt away. It's pure bliss. For me, that feeling used to be a mental reset from a busy work life. Now, in early retirement, it's my everyday reality. Well, almost everyday reality. But how do I pay for it? It's not magic. It's all about smart financial planning. A big part of my portfolio is tied to the very companies that give me this amazing lifestyle. NCL, Carnival, Royal Caribbean. Today, I'm pulling back the curtain to show you how I use the cruise lines to pay for my cruises. Stay tuned. Let's start why we're all here, the love of cruising. There's no better feeling than the moment I step onto a cruise deck. It's a mental and emotional revitalization. You've worked hard your whole life and you deserve this. The question is, how do you move from a once-a-year vacation to a lifestyle? That's what I'm going to show you today. This isn't just about sailing. It's about securing a financial future that allows you to sail whenever you want. So, how did I get here? The short answer is I retired early. The long answer is a result of years of discipline, savings, and strategic investing. It's a long-term plan built on a few key pillars. First, real estate. I focused on paying off my mortgage debt as fast as I could. This was my top priority, but I didn't want to pull all my money into it. The objective wasn't to generate rent, but to be free of it. The day I had no more mortgage to pay was the day I retired. Potentially, I could continue the investment down this line to generate some rent, but I wanted free time to cruise and not be managing the properties. Second, saving and investing. For every $100 I could spare, I'd commit 30 to my mortgage, 15 to a diverse portfolio of stocks, and 20 into gold. This became the nest egg that now provides for me. Third, dividends. I focused on a portfolio of dividend-paying stocks, making up about 75% of my portfolio. Of that, 8% is in European and Canadian stocks, which often have higher dividends, around the 5%. The rest is US stocks, which typically have a lower dividend, 1 to 3%, but are better for growth. This provides a steady stream of income without me having to sell my investment. Fourth, gold. I use gold as a kind of cash wallet. When I receive my dividends, I convert my annual expense budget into gold. Any excess I have from my budget is reinvested into growth stocks. Then, to cover my monthly expenses, I convert a small amount of gold each month into cash. Fifth, I'm lucky, a small pension. I was fortunate to have a small pension from a previous employer, which, while not being enough on its own, provides a solid foundation until I reach retirement age. And finally, a side hustle. My YouTube channel, Cruising After 50, is my side hustle. Right now, it's actually generating a loss, but because I don't need to rely on it, it allows me to grow the channel with total creative freedom and unbiased opinions. But more importantly, with the feedback I get in from the comments from you subscribers. This is how I've been able to create a retirement paycheck for myself. Now then, for the fun part. We're going to look at 3 publicly traded cruise companies: Norwegian Cruise Line, NCLH, Carnival Corporation, CCL, and Royal Caribbean Group, RCL. Not just as vacation providers, but as investment vehicles. We'll discuss their financial health, what their stock performance says about the future of cruising, and what it all means for you. If you want to go deeper on any of the topics or have additional information, please put on the comments below. Please note that financial data changes rapidly, and the data I used for this video is based on the first quarter 2025. So this next section of the video will become less relevant over time. It also has the potential to overwhelm you with data, and that is why I kept it for the end. But you know, it is where all the juicy parts of this video will be. The cruise industry went from a full steam ahead to completely dead in the water during the pandemic. With zero revenue for over a year, these companies had to take on a staggering amount of debt. This debt is the reason we're still seeing different financial strategies and stock performances today. Remember, I mentioned I lean towards the more dividend-oriented stocks, 75% actually. So do note for some of my investment bias showing up. Now let's talk about my personal favorite from an investment standpoint, Royal Caribbean Group, RCL. Their stock is now trading at values much higher than before COVID. This is a huge differentiator from their competitors and is important to me as a dividend investor. That's because Royal Caribbean Group is the only one of these major cruise lines to have reinstated its dividend. This means my investment is not only appreciating in value, but also generating a passive income stream that helps me pay for my next cruise. In their Q1 2025 report, they reported a total revenues of 4 billion. Their adjusted net income was 0.7 billion, which is a significant increase from the same period last year. This is a great sign of profitability. Their revenue also has been on a strong upward trend, reaching 16.75 billion for the TTM or trading 12 months in 2025. Before COVID, in 2019, RCL or Royal Caribbean had a fleet of 63 ships. Today, they've grown to 65 ships. This growth shows their ability to access capital and invest in new vessels like the Icon of the Seas, Utopia of the Seas, and Star of the Seas. By the way, I've got Star of the Seas already booked. What does this mean for investors? Remember, I am not a financial advisor. This is just my personal view. When I look at Royal Caribbean Group, the prices have gone up dramatically. Me, personally, I don't buy at these levels. I mainly hold what I have. The dividends can grow as the stock grows. So it's a good investment to generate those dividends I like. The dividend is currently around 1%, which isn't bad because the stock value is growing big time. Looking at the last 12 months, the stock has shown significant growth. But like any stock, it's had its ups and downs, particularly over the last 6 months. This volatility is why it's so important to view these as long-term investments rather than short-term plays. So what does this mean for cruisers? Royal Caribbean's strong profitability means they have the capital to invest on new ships and innovative features, and this will enhance our experience. You can also expect high occupancy and stable prices, this due to the sustained demand. Now, let's turn on Carnival Corporation. While their latest reports are positive, with record revenues and a strong booking outlook, their stock price still sits below its pre-COVID levels. This is largely because their management is laser focused on on using their newfound profitability to pay down their massive debt. This is a sound long-term strategy, but it means they haven't reinstated a dividend yet. In Q1 2025, they hit a record revenue of 5.8 billion. That's massive. They had a record first quarter operating income of 543 million, nearly doubling the prior year. Their adjusted net income was 174 million, and their adjusted EBITDA, that's earnings before interest, tax, depreciation, and amortization. It's a key measure of operational health. Reached a record 1.2 billion. This shows strong operational efficiency. In 2019, Carnival had 104 ships. Now their fleet has shrunk to 91 ships as they sold off older vessels to raise cash. So for investors, again, this is my personal view and not financial advice. The stock price is still below the pre-COVID area. While it's been a roller coaster the last 6 months, it has grown 100% over the last 12 months. I see it as a good growth stock, and the value will probably go over what it was before the COVID. It has risk, of course. and you'd need to be prepared to hold on for it to at least, the next 2 years to see what potential can be realized. This is definitely a long-term play, not a short-term one. And what about the cruisers? Well, the high demand and record customer deposits mean that their ships are full and profitable. So booking in advance is a good idea. Their focus on debt reduction is a long-term positive, potentially leading to a more stable company and continued investment in the guest experience. Finally, we have the Norwegian Cruise Line Holdings, NCLH. Like Carnival, its stock price has not yet fully realized to its pre-pandemic heights, and they have not reinstated their dividend, of course. Their strategy is similar. Focus on operational efficiency and paying down debt. The company is holding steady, but with a lot of debt due to the building of new Prima class ships. In the first quarter of 2025, NCLH generated 2.1 billion in revenue. That was a slight decrease from the previous year, and they reported a GAAP net loss of 40.3 million. GAAP, GAAP, by the way, stands for Generally Accepted Accounting Principles. It's a standard set of rules for financial reporting. However, their adjusted EBITDA came in at 453 million, which exceeds their own guidance. This suggests good operational efficiency, despite the loss. Before the pandemic, NCL had 27 ships. Today, their fleet has grown to 32 ships, which shows a strong commitment to the expansion despite the debt. What does this mean for investors? As before, and I can't be repeating enough, remember, I am not a financial advisor. The stock price is still below the pre-COVID time. It has grown 50% over the last 12 months, but it's still below what it was 6 months ago, thus showing a lot of volatility. At this moment, I'm just looking at the stock. I'm not buying, I'm just keeping an eye on it. I think it has the potential for a growth stock, but it has high risk right now, and a lot of people are actually selling because of the 40.3 million loss. This is another investment. You need to be in it for the long term and not anxious about short-term price fluctuations. What does this mean for cruisers? Well, new ships like the Norwegian Aqua mean continued investment on the fleet and modern experiences for you. So what does all of this mean? For a cruiser, the financial health of all these companies is great news. Strong demand means they can continue to invest in new ships and maintain their existing fleet. For an investor like me, the story is a bit different. I see Royal Caribbean as a more mature company that is successfully returning value to shareholders through dividends and stock growth. Carnival and Norwegian are in for a heavy recovery phase, focused on paying off debt. Their stocks might be great long-term recovery plays, but for now, they are prioritizing a different goal than returning cash to shareholders. And that, my friend, is how a little of financial knowledge helps me not just book my next cruise, but also fund it. You can check the video here on my future sailings. Perhaps even join me on it. Happy cruising, everyone.